Okay, great. We'll get started. Welcome, everyone. I'm Yvonne Schwab, ACG Silicon Valley's CEO. I am really excited to present you today's M&A Circle event, How Software and Technology M&A Survived the Most Tumultuous Year in Recent History and Came Out on Top, in collaboration with RSM. For those of you new to ACG Silicon Valley, we are the leading business-to-business networking organization in Silicon Valley, providing connections, thought leadership, and enabling personal and organizational growth. ACG is a worldwide organization offering an array of networking opportunities. With over 13,000 members in 59 chapters across the world, ACG provides local connections with a global reach. If you haven't had the chance, check out our new ACG web experience. For the past few months, we have worked tirelessly to update our webpage, and with the help of Aloha Cloud, we now have a wonderful new web experience we can offer to our ACGSV community. So make sure to stop by. We are also offering a variety of virtual events in the coming months. We invite you to go to our website, acgsv.org, to see the full calendar. Next week, RSM is sponsoring an event on how 2020 changed e-commerce strategy forever. We are also really excited to have an event in collaboration with Santa Clara University on gender and racial bias in venture capital. Of course, we have our monthly round robin networking events with the San Francisco chapter. And this coming month, we also have a Zoom makeover, up-level your online screen presence. So if you're interested in finding out what's right and what's wrong, join us. Now we're excited to offer you today's event, which would not have been possible without our sponsor, RSM, so thank you. And I would now like to introduce you to our moderator today, David Van Wert. David is a partner at RSM and is RSM's national leader for M&A in the TMT industry. RSM is the top accounting and advisory firm for middle market companies and M&A transactions in the middle market. David advises private equity and corporate clients on buy and sell side deals and has 15 years of deal experience. David has advised on more than 300 domestic and international transactions. So without further ado, I give you David.
Thanks, Yvonne. Appreciate it. Hello, everyone. Thanks for joining today. I think this should be a great session, just judging by the incredible quality of the field professionals that we have with us today. Let's get introduced to our panel. Maybe Andy, why don't you kick us off?
Hi, everyone. I'm Andy Lead. I'm a director in our technology group at Harris Williams. I've been with Harris Williams for a little over 8 years now, and I focus on a few verticals within technology and software. So it's education technology, supply chain and logistics, and industrial software, and a few other smaller categories. For those of you that aren't familiar with Harris Williams, we are a global investment bank focused exclusively on M&A advisory services. We have 10 dedicated industry groups and 8 offices across the US and Europe. Thanks again for having me.
This is John Delfino. I'm general counsel at TCV, who is a growth equity firm based out of Menlo Park in California. We've got offices in New York and London as well.
Hey guys, this is AJ Jinglapalli. First off, thanks to ACG and David for hosting us here. I'm a principal at Thoma Bravo. We're a software-focused private equity firm with over 70 billion in assets under management. I've been at the firm for about 5 years now, almost, and the whole time I've stayed within our Discover Fund, which is a $4 billion equity-oriented investment vehicle. I lead our healthcare IT coverage efforts as well as fintech. They certainly have spent time in a number of other software verticals, and excited for the discussion.
Excellent. Appreciate it, guys. Well, I think no one will debate that this past year was crazy on many fronts, but the technology industry continues to really be a bright spot in the economy. I guess to paint a contrast, I read somewhere that U.S. GDP growth was at one of the lowest years since World War II. But in contrast, on the flip side, global technology M&A was somewhere around 470 billion, which is second only to the 2000 dot-com bubble. So I think we're seeing a lot of chaos in other parts of the world, but the technology M&A continues to be very strong and growing gangbusters. So I guess for our first question, I'm going to start with the lightning round of give me one word or phrase that you think describes doing deals in 2020. AJ, why don't you start us here?
Sure. Yeah, I was, it's almost a toss-up between two, so I'll take two and hopefully don't steal anyone else's answers. But on the one hand, you saw a lot of proprietary deals, especially through the early summer where there was just a ton of uncertainty around where the markets were going to shake out. We saw a lot of traction with companies or sponsors where we had a great dialogue going well before the pandemic started, and that accelerated our ability to get things done. And then, on the other hand, you also have to focus a lot on creativity because it took a lot of creativity to understand kind of where businesses were going to shake out, what were the trends that they were seeing through the pandemic, and just ultimately figure out what a great underwriting case would be for pretty unprecedented times.
This is going to sound
Andy,
obvious. Sorry, go ahead, David.
Yeah. I'd say it's a toss-up too. I'd say from a phrase, I was thinking about this as AJ was speaking, it's really around either the haves and have-nots in terms of technology M&A, and another one, just given the volume of activities, the deal activity that really picked up in late Q3 and Q4, it's hard not to say fast and furious.
I'm going to go with, I think the obvious one here, but virtual. And so it really changed the dynamic in terms of, everything from diligence, building rapport with the management teams, and frankly, even interacting with, service providers. So.
Nice. I'm going to go with roller coaster. And I guess, John, with your comments of virtual, I think it's a good lead in to my next question, where 2020 was a year of change, no doubt. I know my daughters are getting tired of me talk about being adaptable and resilient and all that stuff. But how did the pandemic change how you approach deals in 2020, and what of those changes do you think will actually stick going forward?
Yeah, it'll be interesting. Again, you have to imagine that there's elements of the process that will, remain remote and virtual. I would hope that, everything doesn't have to sort of remain the way it is today, but you certainly can imagine where, you maybe cut down on some of the frequency of in-person meetings. There's also the thing with, certain advisors is historically, especially on the legal side, nothing was done via video. It was always historical conference calls. And so I do think that there's the element of just a little bit more human connection, even as we think about sort of internal and sort of working groups within the sort of the transaction execution.
Yeah, and I'd echo all of those, and a couple of the things that I think came out of it beyond obviously just getting comfortable with just pure virtual relationship building and virtual deal diligence is one, I think it allowed us just a lot more touch points with management teams. So rather than orienting an entire diligence process around a monumental 6-hour or 8-hour operating diligence session, we were able to get a lot more of the 2-hour, 3-hour more targeted sessions over the course of a couple of weeks versus building up to just one day where we get our time with management. So I'm hoping that sticks around. It certainly lets us get a little bit more targeted and probably gets a little bit more work done in the diligence process. And the other element around it, again, kind of to the point earlier on proprietary deal making, but I think relationships became a big part of how things got done. during the worst of the uncertainty last year. And I think, there's enough kind of momentum with companies now and with sponsors to know where, where if you feel like you're going to be a competitive bidder in a process, or, as a seller, if you feel like you have the list of 3 to 4 names of folks that are going to be able to post, I think it's going to accelerate a lot more of these relationship-oriented dialogues around, these sale processes, and it's not going to be as broad-based as it was in the past.
Yeah, I agree with John and AJ. I 100% agree that the Zoom meetings are probably here to stay, and they will probably replace the faceless conference calls. From our perspective on the sell side, when we are selling companies, to build on what AJ was saying, we're seeing many of our deals are matchmaking situations where it's one-off to a group of parties that have, at least a prior relationship with the management team or some sort of strategic angle. And very much we're taking a very targeted approach to market to make sure that buyers feel like they have an opportunity to prevail and have a realistic chance of engaging with the management team and spending time with them. And we're doing that all virtually. So since the shelter in place happened, of course, like the entire industry, we certainly moved virtual. I would say from the companies that we are advising and that AJ and John invest in, many of them are technology companies. So it was a quicker adoption to working from remotely, as well as using technology to engage. So that was something that was certainly helpful from our sector.
Great. Yeah, I think after a temporary slowdown at the onset of the pandemic, we really experienced one of the hottest M&A markets for technology deals ever in the back half of 2020. AJ, Tumultuous appeared to have a banner year as well. You've got a $22.8 billion fundraise. You've got a massive exit in Ellie Mae. You've got a massive acquisition announcement in RealPage. What were some of the drivers that drove all of that activity, and do you expect the deal velocity and the deal multiples to continue into 2021?
Yeah, so I think the biggest driver of it is the resilience of software, and I think if you go outside of software, most industries started the pandemic asking just how much our revenue is going to decline this year on a pretty high fixed cost base. And with software, it was almost like preserving recurring revenue was just table stakes. And you had the class of companies that were thinking about how is this going to accelerate our bookings because of the increased demand for digital tools. And even the ones that didn't see that huge jump in demand, I think I was really pleasantly surprised with just the ability to retain revenues and even continue kind of hitting our original pre-COVID planning, all based on, one, there's a great kind of contract model with annual upfront payments, which, certainly helped out some companies. And then, the other piece of it is just this kind of software is mission critical for the industry where it operates. And so, there almost isn't even a choice, on removing software spend. So I think the resilience of software as a business model as an industry was a really big driver for the activity, and certainly the pickup in the back half of the year. And as far as 2021, yeah, I mean, I haven't seen anything that would suggest a slowdown, and I think there's only reason to expect that it'll continue at the same pace, and probably with similarly strong valuations in the private and public markets.
Yeah, I couldn't agree more. The software vertical is certainly resilient, and if anything, the pandemic has proved it, and it's just created a lot of interest in the sector. Just a few facts: there's over $1 trillion of dry powder, of private equity dry powder, that needs to be deployed and invested in the space. From our experience, some of our PE relationships, we noticed that some of them were active, but some of them were also on the sidelines during Q2 and Q3, and they're under even more pressure to put that capital to work. And combining all of that with strategic companies have substantial cash balances that they've been building up. Some of their stock prices are trading at all-time highs. And we've also seen a rise of SPACs that are public and special purpose vehicles that are raising money to deploy capital to acquire companies. We're starting to see that driving a lot of competition for just very few software assets of high quality that are in the market. And it's just driving a lot of competition. It's driving valuations up altogether. And then from my perspective, I don't have a crystal ball what will happen, but I agree with AJ. We're not seeing anything out there that is suggesting that valuations and multiples will come down. If anything, a lot of software companies and a lot of sellers are thinking about exploring the market, seeing what's happening with valuations and multiples. And we expect 2021 to be a continued year of that.
Yeah, I mean, I don't disagree with anything AJ and Andy just laid out, and sort of echo all those thoughts. And again, we'll just pile on to say that, I mean, we've seen it in practice for the first month of 2021. And so expectations are it's going to remain very active. Multiples will continue to be sort of where they're at, if not higher. And so it is interesting because software has been great, been resilient, and then sort of we also dabble in the consumer side of things, and that's been remarkable too, because I think, you know, anything that's tech enabled, sort of adoption that we were looking, you know, a few years out to happen, and that was sort of the projected sort of growth model, it's all been compressed and pulled forward significantly, right? And I think sort of that compressed adoption, I think will just continue. Consumer behavior is different. And it's gonna continue to be different this year. No one knows exactly how and how much. So that's why I think, you know, good chance that this will be a continuation of last year to a certain degree, and we'll see how long it lasts.
Yeah, John, I recall you and I talking early in 2020 and about Peloton, and they were sort of plugging along post IPO, and then, you know, that's probably a great example of a tech-enabled business that really got a massive bump as a result of COVID. So yeah, interesting that you know, that I think the resilience is a common theme that I'm hearing, but you know, you're getting pickups not just on pure software, but also tech-enabled businesses as well.
Yeah, exactly. I mean, I think you're seeing that too, and you know, fintech and you know, some other verticals. So.
And John, I also saw, not to steal your thunder, but also saw that TCV announced Fund 11 at $4 billion yesterday. So expect to see you guys active in the market going forward as well.
I hope so. Yeah, thank you. That came out yesterday. AJ, at this pace, will catch up to you guys in a few decades.
Nice. Excellent. Well, I think we've just touched on IPOs, and tech had the most IPOs in 2020. And Andy, you mentioned the four-letter word of SPACs, and Thoma Bravo also just came out with a SPAC. But you know, related to IPOs and SPACs, do you think that trend will continue into 2021? And Andy, maybe you kick us off here.
Yeah, absolutely. So SPACs raised a record $83 billion of capital in 2020, and capital raising activity, even just through the month of January, indicates that it's still remaining strong. I'd say tech continues to be among the most popular areas for investment for SPAC sponsors and investors. Well, when we look at the data, there's currently 86 SPAC holdings that represent $30 billion of capital that's in trust, that is waiting to be deployed in broader technology and software companies. So we know that that's out there, that's an overhang. And then while SPAC, you know, just to put it into context, while SPAC deal activity was certainly expanded in 2021, I would just note that there were less than 20 technology SPAC acquisitions in 2020. So it's still a relatively small portion of the tech activity compared to in the public and private markets. So that's my take on that.
Yeah, so I mean, I'm sort of living this right now, and at the velocity that these SPACs are pursuing targets, even just in our portfolio, I don't see an end in sight anytime soon. Now, again, I think you might hit a saturation point, and who knows, sort of, you know, once you get into the second half of this year or next year, for example. But it's been absolutely remarkable just to see sort of this shift. And I think there's I think people are still trying to figure out sort of and unpack a lot of either the misconceptions, or I think time will tell how these things ultimately play out, right? In terms of, companies that might not have otherwise, sought the public markets. Because that to me that's the starting point of all of this. Is it's just another means to tap the public markets. And if a company isn't otherwise ready to do that for whatever reason, it's not really going to be a fit. But yeah, it's been, I mean, I can't really think of another sort of tool or product like this since I've been doing this that sort of has changed the deal landscape, right? It's a very unique thing. And I know SPACs have been around for a while, but they haven't been used in this fashion. So.
Yeah, it's creative. It's certainly an innovation in financing, which, in my sense is probably going to stick around for a while. And, as an investor, you always love to have a historical track record to extrapolate from. And so it'll be interesting to see kind of what that looks like in the first couple of quarters of this year, just to see where those go. But, I think it's a really innovative, it's a really, valuable financing construct, and I'm sure there are going to be some great candidates for it that'll benefit pretty greatly.
Great. And I know that John, you also lived it with Airbnb as an investor there. Qualtrics just went public today with their IPO. I think that everything that I'm hearing, expecting to see more of the same, if not an acceleration, especially with the faster entry into public markets via SPACs. So it should be interesting to watch. I guess with all of the activity going on, RSM, from a diligence perspective, we saw cybersecurity, healthcare IT, and telemedicine, especially Edtech companies, very active in the market. Given all of that, what do you guys expect to be some of the more active subsectors going into 2021, and why?
Yeah, so out of that list, I mean, the two that jumped out for me personally were Edtech and Fintech. Now, admittedly, I think sort of those tend to be some of our core competencies sort of out of that list anyways. But again, to me, it comes back to sort of just the acceleration of sort of the adoption in and around that. Like, I mean, EdTech, right, is one of those things where there was such disruption, right, due to COVID, that, I mean, that totally changed the landscape of, those companies and their products. And so that to me is, prime for another active year for them. Same thing on sort of the financial technology side of things. As things continue to move digital and mobile, it's actually hard to, like, to me, I wouldn't, like, this isn't just a 2021 thing. Financial technology is certainly one of those subsectors that you could easily see just continuing to sort of evolve over the next decade, just given how it touches the consumer.
Yeah, I mean, we, just to give a couple of anecdotes on it, I agree with John. On the fintech side, EdTech, healthcare IT, it's almost hard to think of an area of software that hasn't been, somewhat positively impacted from the shift towards digital. On the fintech side, we own a business called Meridian Link, which enables banks and credit unions to take in loan applications or account opening applications virtually. And it's historically been a pretty nice, steady, couple of points a year shift from paper to digital processes. And obviously, in the depths of the lockdowns, digital was the only way you could possibly make these applications, right alongside, the government dispersing, many hundreds of billions of dollars in PPP funding, CARES Act funding. And so, you see a big shift one time in terms of just, moving the entire adoption of paper to digital upward. And then it does feel like it's only going to continue from, a almost phase shifted jumping off point. And, on the EdTech side, whether it's location shifted content or time shifted content, that obviously only happens mediated through technology tools. with healthcare IT, member engagement for payers has never been more critical with broader healthcare legislation. But alongside that, care coordination for patients and even just how hospitals and higher ed institutions are able to manage their own budgets and plan for pretty unprecedented chaos last year. All of that's created a massive demand for smarter, more sophisticated software tools to help them with this. And again, I think it's not a big shift upward and then a resulting jump back down when things go back to normal. I think it is going to be much more of a permanent shift upward.
I agree with John and AJ. Certainly EdTech, anything that touches remote learning has been booming. Healthcare IT, as AJ just mentioned, there's a lot of pockets in healthcare IT that are extremely hot. And then FinTech has continued to be a very strong, broader, end market for a while. And we still think that there's, another decade of a good run ahead of it, and potentially more. It's something that's always changing. Other areas that we're seeing a lot of activity are cybersecurity, anything that touches data analytics. And we have seen a big jump in anything that touches e-commerce and supply chain. As everyone moved from shelter and home, there was obviously a big surge in e-commerce. So any of the ecosystems that touch e-commerce and supply chain have been really beneficiaries of COVID and this transition. And if anything, we don't think it's a one-time COVID bump. We actually think it's just an acceleration or a pull forward of some trends that were a few years away from really setting in.
Yeah, Andy, I think that's a great point on the acceleration of adoption and kind of where things are going. It feels like this is more of a push that's going to continue. It's not going to reverse, especially when you're talking about grandparents learning how to use telehealth technology and digital adoption, or teachers who, judging from my brother and sister-in-law, may not be the most technologically advanced group of workers out there, but they have become that by necessity, really adopting to remote learning and hybrid learning models and all of that, really driven by technology. So very, very, very good insights there. I guess any trends that you all are seeing in terms of how companies are coming to market, any change in what you as investors or representatives and advisors are looking for, from a metric standpoint that are being used for deal values. We've always seen ARR and EBITDA in a lot of technology-driven companies, but I just did a deal where the banker said, you will value this deal on February 2022 recurring revenue. So there's a lot of positioning and machinations going on there. And any thoughts in terms of what continues to matter or what will matter in the future?
When we're advising clients on the sales side, every client and situation is unique. So every company has different metrics that we're focused on. Certainly growth, ARR growth, revenue growth are certainly a big focus, and it has been a big focus. But what we've noticed is certain companies have had a COVID bump or acceleration of revenue. So there's a big focus on what is the normalized and steady state revenue. And a lot of what we're doing advising our clients is really in working with them to understand, is this an acceleration of a trend that's just being pulled forward and it's a future and this is the way it will look in a steady state, or is this truly one time? And how do we put a box around that to get potential buyers, strategic buyers, as well as investors comfortable with it? One other area where I'd say that the conversation has shifted a little bit, especially over the last 12 months, is before a lot of our software companies and technology companies, the focus was on growth and ARR, like I said, but it's around retention as well as profitability. Before, profitability was certainly a focus, but less of an emphasis. I think there's now that in a cost containment environment where folks are managing their costs and also trying to grow, profitability has become more under the spotlight. And if it's a software company that is burning cash and supporting their growth, it's really the focus is on path to profitability and how fast that can happen.
Yeah, the first thing I thought of when you asked the question was the inevitable COVID adjusted EBITDA that you're seeing now, and it's a very fair adjustment to make. I mean, certainly no one expects the climate of last year to continue permanently. So I think buyers will be pretty generous in terms of how they evaluate that, especially for businesses with strong fundamentals. The one thing I'd add to what Andy said, and I agree on the importance of retention, which really tells you the story of how mission critical a software company is over the course of the past year. But the valuations where you're buying businesses, you just have to require more growth in your underwrite, and that necessarily means that your market work is even more important than it normally would be. And so I think as we're seeing more companies come to market, as what used to be a mid-teens EBITDA multiple exit for an A+ asset starts to approach the mid-20s, even north of 30. I think being able to tell a real story, not just around the company's dominant positioning in the market, but the broader market growth rates and ability to continue growing alongside that is going to be more and more critical. I've seen enterprise value to bookings or new bookings as a metric people now think about. And again, it's none of these will end up being the ultimate decider for valuations, but just another factor you have to consider when you think about the new underwrites.
Yeah, no, I again agree with all of that. From my perspective, the metrics for the most part aren't necessarily changing in our minds. It's really just maybe better understanding how to interpret them vis-a-vis COVID and some other stuff. And I think that's the trick and the challenge, right? Because there's certainly plenty of businesses, particularly the ones that have seen tailwinds from COVID, right? And you're trying to figure out sort of the COVID bump, how sustainable is that going forward? And is that just really sort of new adoption and new behavior, right? And it's kind of here to stay, or, this is the way the world looks like when people are sheltered in place. And so, so that's kind of been one of the challenges as we try to unpack a lot of this stuff.
Yeah, John, I think that's a really interesting pointer there, because it does seem like a lot of the time we're giving a company maybe a benefit of the doubt for an add back related to a COVID adjustment or something one time that impacted them negatively. But in some situations, you are seeing that pop over the last 9 months or so that really benefited the business. And any thoughts in terms of how you're approaching that? Because it seems like it's hard to say, well, we're going back to what life was before COVID, right? It seems like that's going to be a long and winding road. So how do you think about kind of getting to the right level of adjustment there?
Yeah, and again, this is more of just a high level sort of comment, but it's certainly industry and company specific. But again, it's really sort of going back to the product and the consumer, and just understanding sort of what does the world look like going forward, and what aspects of what we went through in 2020 are here to stay. And so, but yeah, I mean, there's plenty, it works both ways, right? If you're in a company that reaped the benefit of, the pandemic and some of the implications of, what happened the last 12 months, it's great. And you try to use that to your advantage on the next fundraise or even exit. The flip side is, right, when you're looking for new opportunities, right? I mean, you could do anything. I mean, anything from like grocery delivery, right? And you've got companies like that have seen this explosive growth. They're taking advantage of it, right? So they're fully financed, in the near future. But you're really having to sort of think through, okay, well, is this explosive growth they're showing from, March to December of 2020 really illustrative of, the sustainability of that growth going forward? So those types of conversations are the ones we're having.
The only thing I would add on the sell side, when we are advising companies, it's really about a credibility factor on the level of adjustments from a COVID it's a credibility factor. What we always challenge our clients and the management teams is, this is a potential adjustment, this is a more conservative or reasonable adjustment. Does it pass the credibility test? Because ultimately, the CEOs and those management teams are selling that, and they're representing that. So their credibility in front of potential buyers is really important. And that's something that we always think about. I don't think there's any potential investor or buyer when they're looking at a business to acquire when there's a substantial amount of EBITDA adjustments or revenue adjustments that they need to get their arms around with. We try to keep it easy and simple and credible.
That makes sense. Yeah, I think one area where we're seeing a lot of dips in almost all cases really is travel and entertainment, trade shows, those types of things. When you're looking at a company, I think some of these companies say, hey, this is going to go back to what it was before because we've never done, or we had never done a remote implementation before. The demos work so much better when you're in person, or whatever the explanation might be. But it does seem like that's probably an area where you are going to see a shift from an infrastructure standpoint, where your salespeople don't need to travel as much. They can work remotely from anywhere, right? And the benefit of crowding, or the appeal even of crowding together in a Las Vegas trade show, has maybe lost some of its allure. Maybe just off the cuff here, thinking about there have been a lot of announcements of companies leaving Silicon Valley or leaving the Bay Area, and with the increased mobility of labor, and any thoughts in terms of the whole idea of, do you even need an office headquarters, right? I know a lot of companies, Twitter, for example, have said, hey, we're working remotely. Like, that's now policy, right? Going forward, and how do you think that's going to impact investments as well as talent attraction and the whole building a successful technology business up from the ground?
Yeah, I can start on that. I mean, it completely changes the paradigm of how you think about the health of a business, and even just kind of the general comfort you have investing in something. I mean, part of what I used to love doing is walking through a company's headquarters and just getting a feel for, what the energy level is like, what's the quality of the CEO or C-level team's interaction with the junior folks there. And if you have companies that are going to be predominantly or even entirely remote, it certainly becomes, impossible to assess that. And I think, you just kind of have to find ways to work around it, whether it's more diligence going down kind of the usual C-level and maybe direct reports types of interactions that you'd have. And, perhaps there are other productivity metrics that you ask for around, what does the remote workforce look like in terms of, generating lines of code or whatever it is. But yeah, I mean, it's certainly, for companies that are fully virtual, it's something that you'll have to just rethink how you assess company health and general, management team leadership skills.
Yeah, we're certainly seeing a number of fully remote companies, even ones that were started as fully remote companies. We particularly see that in the technology and software vertical in general. But they are going to reach a point where there's going to be some infrastructure needed, and there's an evolution of those companies. For companies that have gone all remote now, that were physical offices, I do think there will be a gradual come back to the office, but I think we'll start seeing more flexible and remote working for the next several years, and that may stick.
Yeah, it's been interesting to see, our companies think through, and again, nothing's really settled at this point, but, think through the decision making of, shifting some or all of, the workforce to remote. I think, like most things, it just really depends on the company, right? In terms of how practical that is. A lot of times it doesn't make sense, both in terms of because of what they do, but also sort of the team and the culture they've built. And right, so like, if it can't really be done in a somewhat natural and organic fashion, probably isn't the right move to just suddenly, pivot and go totally remote. But again, these are all kind of the questions and considerations, that the board and the HR departments are thinking through, where, how can you not disrupt a good thing, especially if it is a good thing, while still giving people sort of the desired flexibility to do what they want. So I think it's going to take time, and there's frankly trial and error too, of people are going to, make a thoughtful choice, but they might have to change along the way.
That makes sense. I guess that looking forward to 2021 and beyond, if you were talking to a business owner or a seller, aside from a call, Thoma Bravo, TCV, and Harris Williams, if you're thinking about doing a deal, what would be one piece of advice that you might provide to someone entering the market?
Yeah, I'd say, sophisticated buyers, and there are a lot of them now in the software world, they know when a company is being prepped for an exit versus when they're being invested in for the long term. And, it's not just about the employee headcount growing, in a consistent manner. It's not just about the product pipeline. It's a million other things as you think about kind of the C-level org changes that you're making, which should all be in line with, the growth and prospects for a company. And so, I think the days of kind of being able to take a few costs out, maybe cut back on the investments, and try to sell off of a maximized near-term EBITDA number or over. I think generally, people want to see a company that, where the exit is not something that's an event for the entire business, but is much more just kind of a part of just the linear progression of the company's journey. So I think, as a seller, I would encourage, certainly this is what we think about with our companies, but just, making sure that you can credibly tell enough stories around incremental growth levers and, all the investments you've continued making with the business, so that there is actually still a lot of, meat left on the bone for the next buyer, and the company gets to keep growing in its, in its market.
Yeah, I agree with AJ. Just to build on that, our advice to business owners is to continue operating the business as if you weren't going through a sale process, and do the right things for the business. If it means invest in sales and marketing or additional talent, continue to do that. To AJ's point, the investor and buyer community are very smart and can understand where there are some levers that they're pulling back in preparation of a sale. I would have to say this because I'm an advisor, but I would say it is really important to hire the right advisor. And I would tell business owners is don't underestimate the preparation. In today's market, buyers move fast and things change rapidly. And being able to think a few steps ahead and having an advisor by your side is really important.
Yeah. So on this one, again, I would say, be prepared, but be ready to do it fast. And again, if you're really just sort of wearing your, hat on from a sort of sell side perspective, it's the market is sort of where you would want it to be, right? And so trying to capitalize that, and who knows what's going to happen with tax reform, but right, we saw some businesses, particularly founder-owned businesses, rushing right at the end of last year to get a deal done. Potentially there might be another sort of flurry of, comparable activity this year, depending on sort of, what the tax changes might be. And then, well, it's an exit, but whether or not it's really an exit, it's sort of in the mind of the shareholder. But like IPOs, for example, is another place where it's the advice would be, and the advice we're seeing, smart advisors like Andy and others is, go quick, right? And like nobody really knows how, particularly the IPO market, how long it's going to be this hot and open for. And look, inevitably it's going to ebb and flow and maybe not fall off a cliff, but like there is that general sentiment of, if you've got a company that's sort of able and close to going public, and that's something you want to do, do it quick. Like there's no reason to wait, right? And so I just, a lot of people are just gearing up to sort of do that prep work. And I feel like conversations used to be, 12 to 18 months to sort of get quote unquote IPO ready. I feel like people are trying to jam that down into, 9 months now, if not less, to sort of really do everything they can. And David, I imagine you might be seeing this too at companies, just to, really get everything in order so they can actually, maintain that optionality to hit the public markets.
Dave's advice all around. You heard it here first. Well, just being cognizant of time, I know we've got about 10 minutes left in the session. Wanted to at least give the audience a chance to ask any questions that you might have. Yvonne, I don't know if you prefer it if it goes in the chat box or just to unmute folks, but maybe just direct your question if it's for someone specific, or just let us know if it's a more general question. Happy to answer any questions you all might have.
I think it'd be best if people would just put it in the chat box and then you can call on them.
Let's see who can type the fastest.
We can also use the raise hand feature.
Do I get to play teacher and call on people if we do that?
It's a feature on Zoom, but I don't think it's showing right now. But if anybody has a question, feel free to unmute yourself and ask it. Or you continue talking. I'm sure you have another question there, David.
I've got questions for days, but want to if there are any burning questions out there, I guess let us know. Otherwise, we can continue on. I guess one thing that we've seen a lot of at RSM has just been add-on activity, right? There's over the last few years, I think, in technology, it's made up, in some cases, close to 70% of the at least deal count going on. What are your thoughts in terms of, will that trend continue? Will there be any shifts in approaches to that, or will investors double down to some extent in terms of the buy and build and roll up strategy?
Yeah, the biggest change I've seen just in the past 10 years that I've been in the industry is add-ons used to be proprietary more often than not, and increasingly you just see competition from whether it's blue chip firms that are just moving down market with funds, whether it's smaller funds that are out there with great local relationships or what have you. Our ability to get these things done without any kind of formal process has gotten it's still a big chunk of what we do, but these add-ons are getting more and more competitive, and this is where I think we found a ton of value in being able to tell a real narrative around the value of the product, and certainly working with founders to figure out why we would be the best home for their customers, their employees, and it's forced us to be more creative. It's forced us to be a little bit more sourcing oriented as we've built out our M&A function within our portfolio companies. So it's all kind of a good pressure on the system. But yeah, it's been incredible just how competitive these add-ons have gotten of late.
I think what we're hearing from an add-on perspective, a lot of our private equity clients and relationships, a lot of them like the companies that they invest in, and they want to double down on them. So in a market that's crazy with a big high volume of assets in the market, they are looking to deploy capital into their and back up their winners to add on new capabilities or new solutions to some of their platforms and continue to grow, as well as also look for new platforms. New platforms tend to be more expensive and more competitive for the buying community and the investor community, but where they're seeing they can get the most potential and the most synergies, revenue synergies with some of the acquisitions are through the add-ons. And we're seeing a lot of a lot of conversations that we're having internally with our clients about where can we expand and add capabilities now at this opportunity in this time of the market.
Yeah, we admittedly don't do a ton of it, just sort of given our core business line. We do sort of, there are examples in the portfolio. But yeah, that to me, what AJ touched upon in terms of just the competitiveness and sort of that's the one thing that sticks out to me in terms of it's hard to find, proprietary, roll up deals nowadays. It feels like they're getting harder and harder and just valuations are creeping up. And so there's kind of always that balance between price discipline and sort of just doing something for synergies for synergy's sake. So
yeah, maybe pulling the string on a little bit more on AJ's comments of the competitiveness for some of these smaller deals. Historically these would have flown under the radar, but being honest, this is probably a good thing for folks like Andy and myself as well, right? Where there's a process being run, a banker being hired for a very small transaction, or what historically might have been viewed as small. I'd be interested to hear your take on, are you seeing smaller mandates and is that, things that maybe you would have passed on before, saying, hey, looking at the multiples, this could still have a very attractive exit. And then John as well, more on the growth phase earlier on, are you seeing bankers and a full suite of advisors getting plugged in, for a much earlier round where you typically wouldn't have previously?
Yeah, as an advisor, our time is is the most precious, so we have to figure out where to spend time. And if it's a business that is maybe smaller but very high growing in a core market or a core subsector that we focus on, that's something that we take a hard look at and think about internally, because we know if they want to raise capital now, that we could continue to be a partner to them over the years to come and potentially advise them on their next capital round or ultimate exit. So that's something that we think about. But I think the market's been so busy, we continue to move up market and are looking for opportunities that make sense and fit with what we're looking to do.
yeah, and David, on your growth question, we're seeing a little bit more in terms of the equivalent of like a sell side advisor for kind of pure growth rounds. Again, it really just depends. I mean, again, you would typically expect that as the company is sort of later stage, and so it's more of the perhaps last round before IPO, and that's really sort of the advisors trying to get their foot in the door there. Now, I would say even if there's not an advisor involved, the amount of capital sort of pursuing investment opportunities makes, frankly, every company and every round somewhat competitive with or without an advisor. And so very rarely are there companies out there that, frankly, people haven't emailed or beaten down the door to talk to them. And so I think it's really just a nature of the business now of trying to kind of get your edge and build rapport with these companies.
Great. Well, now that the audience has had a chance to maybe marinate on a question, last opportunity to ask it.
Hi, yeah, I can jump in here. Just curious, thinking about potentially increased regulatory and antitrust review of deals going forward. I mean, do you look at that at all as potential impediment, or as you're thinking about potential companies you could be investing in the fields that you already have a strong edge? Is that playing out all as far as how you're thinking of future deals and something you maybe wouldn't have thought of it in the past?
I can go first if you want. Look, it's certainly on the radar. I think we haven't really had to worry or scrutinize it all too much yet, just because, again, I think this is more of where we might see it would be big tech coming in to look at one of our portfolio companies, for example, and how that might impact sort of the ability for the company to sell itself and sort of who the buyer might be. But yeah, it's I think it's evolving real time, but that's really the situation so far, where we've given it some thought in terms of how that might impact, you know, potential exits for where we have some of our investments. Less so as it relates to sort of new investment opportunities, or even just sort of what some of that enhanced scrutiny might mean for us.
Yeah, I think, you know, from just an investment perspective, regulation tends to require additional tools to help, you know, with compliance, and that's where you know, we find a lot of great opportunities both for platforms and add-ons for existing GRC focused businesses we have. You know, we haven't really thought too much about it as an impediment to getting deals done. Certainly, I think, you know, as the climate evolves, it'll be something we want to monitor. But, you know, for the most part, I think, as with pretty much any broader macro change, you know, there tends to be a way of solving it or responding to it with more software. So it's been, you know, it's one of the ways we think about building out an investment thesis in a market, but I don't think we've seen it as too much of an impediment to getting deals done.
Yeah, I would just echo what AJ just said. Is in some software markets, regulatory changes are great. It's an impediment to drive software adoption and to buy new software. From a deal advisory and deal scrutiny perspective, look, regulations have continued to evolve, and it's continued to be a part of every deal, no matter what, you know, what time we are in. Yes, there's a lot of talk about upcoming regulatory changes, but it's still too early to tell what the impact will be at this stage.
Great.
Well, I know we are coming up right on the hour here. Gentlemen, you nailed it. Perfect timing. Appreciate you taking the time today, and appreciate everyone in the audience joining us for the session. Yvonne, any closing remarks you'd like to make before we conclude?
Yeah, I just wanted to thank you again for an interesting discussion, and I really hope that everyone who attended today got to take something away from this great panel that we had here. And wanted to thank you all for your time, for your expertise, and I hope to see you again. Thank you everyone who attended. If you have any suggestions, email me, email Carol, and otherwise we'll see you at another event. Thank you to everyone.
Thank you.
Thanks, everyone.
Thank you.
Thank you.
Thanks. Take care.
Thanks.